You may have heard the Reserve Bank has raised risk weights on consumer loans given by banks and NBFCs. Now let us see what this jargon means. Risk weight has a lot to do with the capital of a bank or of an NBFC. Every loan that a bank gives is lent from depositors' money and a small part from the shareholders' capital. Reserve Bank and other global agencies like the BIS require that as a whole banks must have 8% capital adequacy. That means for every 100 rupee loan, 8 rupees must come from shareholders' money, 92 rupees from depositors. Now all loans are not equally risky. So banks don't have to, by rule, put 8 rupees of shareholder capital behind every 100 rupee loan. For instance, investments in government securities, they are very safe. They require hardly 25 pice of shareholder capital. Secured loans like home loans also require less capital from the shareholders because they are less risky. In banking language, 100% risk weight means full 8 rupees capital to be maintained per 100 rupee loan. Now, what did Reserve Bank do on Thursday? Reserve Bank said risk weight for unsecured loans and loans to NBFCs is being upped from 100 to 125%. So banks have to keep not 8 rupees but 10 rupees for every 100 rupees lent as unsecured personal loans or lent to certain category of NBFCs. NBFCs similarly have to keep 125% risk weight on the unsecured loans that they lend to their borrowers. Now, capital is expensive, so if more capital has to be set aside, banks will have to push up the price of the loan by 10 to 50 basis points to cover the capital cost. What's the impact of RBI's action? First, NBFCs, they are the most hit. They borrow almost 50% of their funds from banks. The rest of the money they take from money market and from public deposits. Now, bank loans that were cheaper than the other two, money market and public deposits, will become expensive by say 10 to 50 basis points. Secondly, NBFCs have to set aside more capital for unsecured loans. So, NBFCs making personal loans will have to raise the cost even more to account for costlier funds and for more capital. Third, they may not be able to raise the cost for all loans since some personal loans, credit card loans are already at 18, 20, 24%. So these NBFCs may have to take a little bit of hit on their margin. So the most affected NBFCs are the ones who give more unsecured loans like SBI cards. All their loans are unsecured. Bajaj Finance, almost 40%. AB Capital, and to a lesser extent, companies like L&T Finance, Chola Investment, MMFSL and Shriram Finance. The last one, of course, is more a vehicle financier, which is not affected. Also, NBFCs depending more on banks will be more hit. I have just given you a checklist of what is the impact on NBFCs which depend on banks. Okay, now let's come to banks. Banks have to use up more of their capital to back the NBFC and unsecured loans that they have already given. But they won't be hurt much because most banks have much more capital than the minimum prescribed by Reserve Bank. How much each bank's capital will get eaten up will depend on how much they are exposed to unsecured loans and NBFCs. And now here is a list of banks, their capital adequacy or tier 1 capital before the rules and their capital adequacy after they set aside more capital as per the new rules. Basically, banks are not hurt that much. Only they may slow down their lending to NBFCs and unsecured loan borrowers because of the Reserve Bank's warning, the Reserve Bank's signaling. In short, if you see the impact, following will be the impact. First, NBFCs may see some hit on their loan volume and even their margin, but here again, not the housing and vehicle loan companies or MFIs, all excluded. Likewise, mushrooming fintechs who give loans via their phones may have to pipe down a bit. The second, consumption may be hit as consumers may find fewer loan givers and what's available in the form of loans is coming at a higher interest. Third, Some borrowers have been taking loan from one bank to pay another NBFC or to pay another bank. As the loans become hard to get, these guys may default. So a small rise in NPAs for banks and NBFCs can't be ruled out. Next, equity derivatives have been seeing a boom in volumes. Maybe some of this is through borrowed money. These volumes may also be hurt. All told, this is not a back-breaking rule. Before COVID, the risk weight on unsecured loans was 125%. Reserve Bank lowered it post-COVID to stimulate, to encourage consumption. It's just going back to the old roots. Now that normalcy has been returned, so rah-rah consumer and BNPL, buy now, pay later loans may stop, but impact on GDP, I doubt it.